Let's talk about the numbers and the performance for the quarter gone by. Amit, good morning. Thank you for joining us. Let's first understand that net loss for the quarter gone by has widened to 159 crore and revenues are also down 10%. Shouldn't it be the other way around, that revenue should be up and losses should be down?
Hi, good morning. As you are aware, we had a quarter-on-quarter improvement in our both revenue and profitability. Quarter one of this fiscal year was affected by the integration of Spot On with Delhivery, which is well behind us. And from there, we continue to grow strongly on both revenue and profitability. Our profitability from quarter one of negative 217 crore of adjusted EBITDA has improved to plus 6 crore of adjusted EBITDA. And even on EBITDA basis, we are almost break even at minus 4 crore. The incremental margins in our business continues to be strong. And as the growth momentum continues, we expect to continue to improve on profitability.
Okay. So do you think that now that integration is behind, both in terms of where the economy is headed and where the business is headed, Q1 onwards, things would be significantly better?
We expect quarter one volumes to be actually strong. Generally, quarter one is a weak quarter of the year. This is something I had highlighted even a year ago, almost at this time. However, quarter one this year continues to be a strong quarter, and we are optimistic about servicing a larger and wider set of customers on back of superior service quality, which should deliver a good growth and hence improved profitability.
Right. Also wanted to understand, what exactly are you seeing in terms of levers that will propel the business going forward? What's happening with demand, for instance, on ground? Because what we're hearing from e-commerce companies is that there are only tailwinds in place.
Sure. See, e-commerce as a sector will see different experience for different set of companies, and individual players will see a very different impact. The good part for us is that we service, over 10,000 customers in e-commerce, from the best or the top e-commerce platforms to a large number of SME and long tail retailers. We service the whole bouquet of customers. And within this category, you will see different companies having different times ahead. The good part for us is that we service all of them. Overall, we expect the growth in e-commerce industry this year to be, slightly lower than what the medium-term, long-term average is. When we track our own record, we basically see, or industry record, when we track, overall industry has grown well over 35% year on year on a CAGR basis for last 5-6 years. And even if you were to lower it to 25-30% over next 5 years, that's a fairly healthy number. For this year, we believe the industry growth could be lower than that, maybe in range of about 15-20%. The important part, or the good part for us, is that that such difficult times are the times which really makes businesses make the right decisions. And this is the time when we would expect to gain more share on back of superior quality and lower cost structure that we have. So because of this, we are very optimistic about the future.
Let's just look at the operational performance as well, because your adjusted EBITDA margin improved this time around, the incremental gross margins as well in the core express parcel and the PTL business that continue to remain above 50%. Do you think that this can be attributed to better network capacity utilization? And more importantly, what are the projections now on these parameters?
So this is the improvement in profitability is driven by a number of things. One is our tractor trailer strategy. We started inducting 46 feet tractor trailers into our network a few years ago. And these tractor trailers are more efficient on a cost per kg per kilometer basis. So as more and more tractor trailers get inducted into our network, we will see our middle mile costs going down. The second part is the utilization across the network continues to improve. Now, this is driven by proprietary algorithms which do capacity planning in various parts of the network, or in fact, all parts of the network they do. And the third part is that the synergy that delivery derives from multiple business lines. So, for example, we have been building the full truckload exchange separately, but last quarter was when we opened up the demand of deliveries trucking onto that platform, which allowed us to reduce our sourcing costs for our core business. So it's it's a combination of things which is leading to improvement in profitability.
All right. Appreciate your time then. Thanks so much for joining in and giving us a view on what your growth levers are and what the outlook is when it comes to delivery.